know anything about finance, we know that there's something called there's no free lunch. What that means is when you try to get something, put your money into an investment that has a huge return potential, the cost is going to be a huge level of risk. So if you look at that on the flip side, investing in startup tech companies has enormous risk. These companies have virtually zero track record in terms of revenue. So to compensate for that risk, VCs need to look at a company and you need to prove to a VC that you have a huge return potential. In the world of startup tech, we look for a return that we call 10x over 4 years. 10x, all that means is we want to get 10 times the money we put into your company out of the company within a 4-year time frame. The ways that we are able to get this type of return is only by exiting the company, getting rid of it outside of our portfolio by either a strategic acquisition, an investment acquisition, an initial public offering, or an employee buyout. So when VCs look at a company to invest in, they know that they have to compensate for risk of each individual company, as I mentioned, but they also have to compensate for the risk of all of the other companies in their portfolio. In venture capital, we have something called a 2, 2, and 6. What that means is when you're a VC and you're doing proper due diligence and you're making investment decisions, you can, on average, expect that 2 of the companies are going to be amazingly successful, 2 are going to go bankrupt right away, and then 6 are going to be what we call zombie companies, or walking dead, living wounded. This type of company is the type of business that treads water. It never really hits that high return. It doesn't hit that exponential growth. And to be quite honest, this is actually the worst type of investment for a VC. The reason for this is because as we have a company in our portfolio that is a zombie, we don't know if one day it's going to take off and it's going to earn those high returns that we need, but we don't know that if it's going to go bankrupt or it's just going to stay at that stagnant level where it's never really going to break out of it. So it's just sucking all of our energy, our focus, our capital, our other resources, and it's never going to amount to anything because, as I mentioned, the only way that we earn a return is by selling a company. So I just want to see a show of hands. Do you think that a good business equals a good VC investment? Yes. You're right. Not necessarily. A company can be very successful. It can grow at a steady rate of return from one year to the next. It can make the owners of the company very wealthy, and it can make the employees very happy, and it can make the company very stable. But that doesn't necessarily mean it's a good VC investment, because as I mentioned, unless a VC is able to resell a company to a strategic acquirer or an investment acquisition or an IPO, they're not going to make the return. It doesn't matter if a startup company that's in a VC's portfolio is earning a large return, earning a large amount of revenue and earning a large amount of profit, because all of that money either goes to the owners of the company or it gets driven back into the company to help it grow and achieve its milestones. So that capital is never paid out as dividends to the investors, and those investors cannot take that money and give it to their investors. So it doesn't really matter if the company is earning revenue or not. The only thing that matters is the ability for a VC to buy a company at a really low price and then sell it at a really high price. Another question, does a bad business mean that it's a bad VC investment? Put your hand up if you think the answer is yes. Not necessarily. If you define a business, as you should define a business as the type of company that can make money, then that doesn't necessarily mean that a company that can't make money is a bad VC investment. Because as I keep saying over and over, the only thing that matters to a venture capitalist is are they able to buy a company cheap and then sell it high. It doesn't matter if the company is making money or not, as long as they can do it. Oftentimes, it is an important element that a company can make a high level of revenue and a high amount of profit so it can grow, but it's not the be-all and end-all. A good example of a bad business that would be an excellent VC investment is Instagram. That company made zero earnings before it was bought out by Facebook for $1 billion. And it continues to not earn any revenue. But the thing is that it wasn't acquired by Facebook to earn revenue, per se. It was acquired for a whole world of other different reasons, and VCs understand that. They know that if a company has this very niche, unique type of technology that's going to be extremely valuable to an acquirer somewhere down the road, and if that technology doesn't necessarily have the ability to earn revenue, but it could be an amazing investment, an amazing asset for a conglomerate, then it would be a good VC investment. So it's really important for an entrepreneur who thinks that one day they might want to achieve VC funding to keep all of these elements in mind. So after hearing this presentation, you think, okay, my company still is a good company to receive venture capital financing, then you really have to speak, just like a good salesman, to your customer, the VC, who could potentially buy your equity. So you have to prove to them that your company has the ability to achieve exponential growth. It could achieve a 10x return within 4 years. If you could prove to them that you have some solid, realistic exit strategies, perhaps a list of acquirers that are in the same industry as yours, who have made similar types of acquisitions in the past, who you feel they're on a trend that could line themselves up perfectly with the type of company that you have, then that is a very good thing to present to a venture capital fund, because you're almost doing the work for them. You're saying, look, there's a great chance that somewhere down the line, you're going to be able to sell this company to one of these big conglomerates at a very high price. Also, traction, of course, you got to show the momentum that you're able to achieve. And as I mentioned, startup tech companies don't necessarily earn revenue, but you've got to be able to prove that your company has the ability to expand. Whatever type of historical data you can use to prove that is a very good thing for VC. Also, as I mentioned, you have to have barriers to entry, meaning that your type of technology cannot be easily ripped off, nor is it the type of technology that somebody can just invent on their own without needing to copy you. Patents are the biggest and most common barrier to entry. If you've got a very unique, niche type of technology, get a patent on it before you approach a VC, so that you can communicate to that VC that your technology and your invention is protected, and they won't have to worry about competitors popping up out of nowhere after they invest in your company. Also, another thing I just really want to drive home, that you as an investor, as an entrepreneur, do not be discouraged by VCs. I have companies pitch to me all the time, and I say to them, look, I love what you're doing, love the passion, love the product, love where you guys are going, but I'm sorry, I cannot invest in your company. It doesn't fit our mandate. It's not going to get the type of returns that we need to achieve in order to do our job, which is give high returns to our investors. And then when I see the faces of these entrepreneurs, they get really upset. And I have to explain to them, look, that doesn't necessarily mean your company's a bad company. It could be an amazing company. Just figure out a way to bootstrap, try to earn revenue, try to grow it on your own without needing venture capital. If you could do that, that's a lot better, actually. Because then you're doing it yourself, and you don't have to sell your business. And anybody in finance knows that the most expensive way to raise money is to sell equity. So, just like to thank all of you for your attention. I don't know if we're doing a Q&A session now or afterwards. If anyone has any